Good day. Welcome to the session. Just to introduce myself, my name is Carl van Rensburg. I'll be the lecturer for this course during this year. I'm going to start with the first lecture, giving you the information. Let's go through the slides. We look at Financial Management 1, Week 1. If we look at the learning outcomes for this lesson, by the end of the lesson, you should be able to describe the main forms of business organizations, describe the key financial goal of a media business, explain the role of financial management and accounting in an organization, explain the main functions of a financial manager, explain the importance of non-financial manager being acquainted with the basic principles of financial management, describe the relationship between financial management and institutions, and describe the agency problem in financial management. Okay, the objectives of a business. One must understand that a business exists primarily to make money for its shareholders. And when we talk about making money for its shareholders, we talk about wealth maximization. So whatever the business does, it must always keep in mind the objective is to maximize the wealth of the shareholders. Shareholders are people that hold shares in a company, and they get rewarded for their investing their money in a company by means of dividends and by means of growth in the share price. So when we talk about wealth maximization, we must look at actions that will increase the share price over time, and also the company will be able to pay dividends to the shareholders. That is opposed to normal profit maximization, where you simply want to make as much profit as possible without thinking of the long-term consequences of it. Let's look at the different forms of business ownership in South Africa. We have the following. We have what is called a sole proprietor. We have partnerships. We have closed corporations. We have private companies, and we have public companies. So if you look at the slide, I'm going to show you the form of the business in terms of liability, what liability the owners of the business has for the debt of the business. We're looking at capital, how do they raise their money, and also how many people are involved in such an organization. So sole proprietor, this is simply me, myself, I. I am the owner of my own business. Now, in terms of a sole proprietor, the sole proprietor is the legal entity. The business is not a separate legal entity. The sole proprietor, the owner, is the legal entity. And as such, the owner has unlimited liability for the debts of the business. So if the business owes R1 million, the owner must pay it. Okay, because the owner is the legal entity. So he's got unlimited liability. How does he raise his capital? Either he uses his own money or he borrows money. He cannot issue shares. He cannot do anything like that. So it's his own money, and he can borrow money. And how many people are involved in the business, owns the business? Only one person. Okay, then we have partnerships. Now, partnerships are between 2 and 20 people. They get together and they say they want to start a business. Now, in terms of liability, again, the partnership, the two individuals, if it's two partners, they are the legal entity. They form the legal entity. And as such, they are jointly and severally liable for the debt. What we mean by jointly and severally means that if the partnership owes R1 million, partner A must pay 500,000, partner B 500,000. And if partner A cannot pay, partner B must pay the whole million, and vice versa. So they are jointly and severally liable for the debt. How do they raise their money? They can provide their own money and they can borrow. Again, they cannot issue shares, so it's simply their own money goes into the business. Thirdly, we have what is called a closed corporation. Now, you cannot have closed corporations anymore in South Africa. Sorry, you cannot register a new one. Those that still exist are still in existence, but you cannot register a new closed corporation. The background to that is that in the 1970s, the government at the time decided that it's very expensive to register a company and to run a company for small businesses, because of the fact that a company had to be or has to be audited by auditors. So they created this thing called a closed corporation, which is fairly similar to a company. However, they don't need to be audited. They simply have to be reviewed and their books signed off by someone with a BCom degree. So they started a closed corporation. Closed corporation is a legal entity on its own. Okay, so in terms of liability, the members, the people that owns the closed corporation, these are called members. The members have limited liability equal to the amount invested in the business. But this is normally when you start a business, you'll have 100 Rand share capital, or this case member contribution, or 1,000 Rand. So the liability, if it's 1,000 Rand, the members will have liability of 1,000 Rand. If the closed corporation owes R1 million, then if the creditors want the closed corporation to pay the money, they must sue the closed corporation, and they cannot sue the members. Okay, so in terms of members, it's between 1 and 10 members. Then we have a private company. Private company shareholders are limited to the amount invested in shares. Okay, so private company, they have shareholders. They issue shares, but not to the public. It's a private company. They can issue shares to friends or people they know, or people that want to buy in, but they cannot just issue it to the public. Okay, that is done by public companies. The liability, again, the private company is a legal entity on its own. And therefore, if you want to sue the company, you must sue the company. You cannot sue the shareholders. Okay, and they issue shares and they borrow money. Public company, again, the liability, shareholders have limited liability to the amount invested in the shares. How do they raise their money? They issue shares on the stock exchange and they borrow money. And it can be one or more people. Obviously, if it's on the stock exchange, it's probably a lot more people. So those are the forms of business ownership. If we look at types of companies that we have, we've talked about private and public companies, but we now have to look at the different types. So we have what is called non-profit companies. These are companies that do not exist to make a profit. These are typically your charities, church organizations, NGOs. So they are non-profit companies. One must just be careful. It's not that they are not allowed to make a profit, because you cannot control that you should make a loss every year, because if you make a loss every year, you cannot exist. What it means is the profit they make, they cannot distribute to the shareholders. So that is primarily, they can make a profit, but then they must apply the profit in in the business in the future, but they cannot distribute it to the shareholders. Profit companies, that's your normal business companies. They try and make a profit, which they can distribute to the shareholders. Then we have state-owned companies, SOCs. Okay, that is SAA, Eskom, etc. These are state-owned companies. Under profit companies, state-owned company, we've got private company, and it will say PTY Limited, Proprietary Limited. And that's a private company, cannot offer its securities to the public, and there are restrictions on the transferability of the securities. That means they cannot offer their shares to the public. Then under the profit companies, we have personal liability companies, incorporated. So behind the name will be INC, to show that it's incorporated. The same as the private company, but the memorandum of incorporation states that it is one, and the directors are held liable for the debts of the company. These are normally professional people like lawyers, doctors, engineers. Pardon. So that's your personal liability company. And then you have a public company, which is Limited Ltd behind its name. So those are all the companies listed on the stock exchange. Those are limited companies. If we look further at the accounting and legal requirements for each form of business, okay, if you start a sole proprietor, there are no legal requirements in terms of registration of the business. And you can just say, I have a business. Okay, I'm a plumber. I'm just going to do my work. So I don't need a registration anywhere. So sometimes you will have to register or get a license from your local government or your municipality, but generally you don't need, there's no legal requirement. In terms of financial statements or financial reporting, it's not regulated. In other words, there's no requirement. You do not have to publish financial statements every year. It's just, you can keep it in the back of a cigarette box if you want to. Having said that, obviously when it deals with tax and SARS, you have to declare all your revenue and expenses. So, but it's not a requirement. There are no particular legal layout, etc., in the way that you must report it. So tax, the owners pay tax in their personal capacity. Because the owner is the legal entity, the owner will pay the tax in his own name. Okay, again, with this partnership, legal requirements, there are no legal requirements for partnership. What is recommended, though, is that you have a partnership agreement. These sort of agreements, when you set up a business, you're two friends, everything is happy, and you say we're going to be partners in the business, but inevitably someone will get upset with the other one. Or let's say one person dies. Now the partner that dies, his spouse is going to take over the business. And then the other remaining partner doesn't want that. So you have to set up a partnership agreement to make sure that in the event of certain things happening, what are the partners going to do? You also have to agree in your partnership agreement how to share the profits, etc. So that although it's not a legal requirement, it would be wise to have a legal partnership agreement. Again, the financial statements, it's not regulated. And the partners pay tax in their personal capacity. Okay, if we then go to closed corporation, these are some legal requirements. For these companies, okay, you cannot register one anymore, but when you could register, you register it with the CIPC. It's the Company Intellectual Properties Commission, so you register with them. And in there will be a founding statement. Okay? And there'll be a certificate of incorporation, and there'll be an association agreement. Now, that association agreement is fairly similar to your partnership agreement, but these are legal documents that you have to file with the CIPC if you start a company or closed corporation. Remember that the closed corporation is a legal entity on its own. So in terms of financial reporting, financial statements must be prepared, but not audited. They must be reviewed and signed off by a BCom graduate, but it doesn't need to be a chartered accountant or registered auditor. Okay, in terms of tax, the closed corporation pays tax on profits in its own name. So the closed corporation will have a tax number, you will have registered for tax, and you will do your own tax return. Private company, okay, there we have a memorandum of association, articles of association, and certificate of incorporation. Now, again, these are legal requirement documents. Your memorandum of association is fairly similar to the partnership agreement. Okay, it sets out when the company must meet, how often, how many directors they must have, etc. So that will be in those documents. They must prepare financial statements, and they must pay. They must be audited. Okay, if we look at the tax, the company pays tax on its profits. Just come back to the tax. In South Africa, we have a tax rate for companies. At the moment, it's 27% of the profit. And so CC, closed corporation, public companies pay 27% of their profit in tax. The sole proprietor and the partnership pays tax on a sliding scale. So if you, the first 96,000 Rand is tax-free, and thereafter you start paying 18%. And once it's over 1.8 million, then you pay 45% tax on your profit, on the profit above that. So it is wise, if you're considering going to a business and you believe you're going to make a lot of money, it doesn't make sense to be a sole proprietor, because you're going to pay a lot more tax as a sole proprietor than what you would pay as a company. Okay, so public company, those are the things you require there: memorandum of association, articles of association, certificate of incorporation, prospectus, minimum subscription fulfilled. Okay, so again, it's a lot of legal documents. If we look here at the prospectus and minimum subscription fulfilled, if you, what happens in reality in life is someone will start a company, and then the company grows. They employ more people, and the company grows a bit more, and they employ more people. And at one point in time, they need a lot of capital to grow bigger, or the owner of the company, or the shareholders, one or two shareholders that they are, decide they want to cash out, they want to retire or something similar. So then they'll say, no, that we're going to list the company on the stock exchange. So you'll go to one of the financial institutions that assist you with this, and they will drop a prospectus. The prospectus will say, my company that I have, this is what we've been doing, this is what our financials have been looking like, and we are going to list it on the stock exchange. And then it says, okay, but for us to list, we want to issue, let's say, 1 million shares. Pardon. But for us to list the company, we must at least have 500,000 of the 1 million shares. People must apply for that, and that we know we're going to be able to sell at least 500,000 shares. Okay, so that's in the prospectus, and then the minimum subscription fulfilled says, okay, we have got 500,000 shares sold. So that's what the legal requirements are there. Financial statements are prepared and audited, and the company pays tax on its profits. So if we now look, we've looked at different forms of businesses and legal requirements and tax implications. But we said that the business is there to make profit for the owners, create wealth. So in terms of financial management decisions, those are the decisions that financial management take. We have the following three. Okay, so the one is called capital budgeting. And capital budgeting is the process of evaluating and selecting long-term investments that are consistent with the organizational goal of maximizing owners' wealth. So what are we talking about here? If you have a business and you now you want to grow, you want to make more money. Okay, so let's assume I am SA Breweries, and I now want to make more money. Then I have to look and say, okay, I cannot sell more beer because the beer market is saturated, so I cannot really make money there. So I can say, okay, maybe I should produce ciders, for example. Okay, so then you will go through a process which is called capital budgeting. You will say, okay, to produce ciders, I'm going to need a factory, I'm going to need certain plant and equipment. So that's my capital outlay. Then I'm going to start producing and I'm going to sell. And you do a whole cash flow projection of this business. And then you evaluate the business in terms of the finances to see whether you are going to make enough money. We talk about the weighted average cost of capital. You must make sure that the money that you make is, in today's terms, is above the net present value, is above the weighted average cost of capital. But these are things that come later in financial management. But the process is called capital budgeting. So once you've decided, okay, I'm going to go for this extra factory, then I have to look at my capital structure. Now, capital structure says, okay, when you finance your business, we looked at the previous slides and we had said, okay, they can borrow money or they can issue shares. Now, if they issue shares, that's called equity. And if they borrow money, that's debt. So in the capital structure, we must look at the combination. How much of equity are we going to use? In other words, our own money, and how much are we going to borrow? And there's a whole process of how to decide that, because each of these, equity and debt, has a cost to it. Debt, we pay interest on. So the banks, when we borrow money, we must pay interest to them. That's how they make their money. Our shareholders, when they put money in the business, the equity, they want a return on their money. So we have to pay them a return in the form of dividends and the increase in share price. So there's a cost to both sides, and we must then look which combination will minimize the cost. Okay, and then we have, third one is working capital decision. Now, working capital can be defined informally as the money needed by the organization as a float to meet the day-to-day expenses. More formally, working capital represents the difference between current assets and current liabilities. Okay, we will get to these terms later on, the current assets, current liabilities. What working capital is about, and when I studied, we were told that there are three most important things in financial management. The first one is cash flow, and the second one is cash flow, and the third one is cash flow. Okay, so working capital really looks at how you manage your cash flow. Things that we look at there, obviously your cash in your bank, that's a current asset. We look at your debtors, those are people that owe you money. You must see how to get your money from them. Your stock or inventory. the stuff that you purchase to resell, that represents money, so we have to see how to manage that. And under our current liabilities, we have our creditors, the people that supply to you, that you bought from on credit. So that will be our current liabilities. So those are the three management decisions. Okay, here's a bit more detailed of the functions. Okay, those are the decisions, here are the functions. Financial planning and analysis. Okay, so when you start operating, we compile what we call a budget. So that's part of our financial planning. We say this is how much we're going to sell for the next year. This is how much it's going to cost us to produce the products that we're selling. This is how much profit we're going to make. So that is called your budget. And then once you start operating, you then compare actuals with your budget, see how you are doing, and that's what we talk about, the analysis. So it's the financial planning and analysis. Okay, investment decisions, that's what we referred to earlier as capital budgeting. Okay, financing decisions is what we called here the capital structure in the previous slide. And then under the working capital management is your cash management. That's your day-to-day management of your bank. Relationship management, that's how you deal with your customers. Dividend decisions. We've said that you must reward your shareholders through payment of dividends. So dividend decision is the decision that's done by financial management or the directors of a company. What we are saying is, if you made R1 million profit, you cannot just pay out the whole million as dividends to the shareholders, because if you want to grow the company, you need to keep some of that money back to grow the company. You're going to need to replace equipment, vehicles. So you can't just take all the money and give it to shareholders. You first have to make sure that you pay other things as well. Okay, risk management. Risk management is closely linked to your cash management, but you have to manage the risk, the different types of risk, financial risk, business risk, etc. So you have to manage that. Then financial reporting. That is your annual financial reports. That's also part of the role of the financial manager. Financial strategy, that's your long-term strategy, how you're going to manage the finances of the business. And then working capital management. That's what I've mentioned before. That's your debtors, your creditors, your inventory, and your cash. If we look at financial markets and financial institutions, because now we said we can use our own money or we can borrow money. So how do we raise this money? Okay, so external funding can be obtained through the following. We can do it through financial institutions. Okay. Now, financial institutions are institutions that take the money of people that have surplus money, and they lend it to people that require money. So the banks take the deposited savings and they lend these to people that need money. So that's a typical financial institution function. Financial markets, which is defined as a meeting place where suppliers and demanders of funds come together. And there are two types of financial markets, and we distinguish between the two in terms of time it takes. So the one is called money market, which deals with short-term finance, and that's usually less than 1 year. Okay. In finance, when we talk short-term, long-term, short-term is always less than 1 year, long-term is more than 1 year. So the money market deal with short-term finance, usually less than 1 year. Funding in money markets is raised by the issuing of marketable securities, such as SA Treasury bills. Okay, so these are short-term money. You can also invest in the money market at your local bank. They will open a money market account for you, and you will get your interest on your money market account. So it's not restricted to businesses only. As I say, you have access to it through your normal bank. Capital markets, on the other hand, these are markets where the supply and demand for long-term money, where debt securities are traded. Okay. The main securities bought or sold are shares and bonds. Okay, so capital markets, that's where you sell your shares, and where you raise bonds. And we'll come to later in the course, I'm sure we'll be covering in more detail what each of these mean. Okay, if we then look at, we said we want to maximize wealth, but we also need to make profit. So we have to look at some ethical considerations. Okay, so if we simply look at raising money, a profit, for example, if I'm a Cape Townian, so if I refer to Cape Town and giving examples, just bear with me. I decide I want to open a brewery in Observatory in Cape Town, next to the Liesberg River. And then I have a lot of waste that must be taken away, and that I have to pay contractors to remove from my site, which costs a lot of money. So instead of doing that, I decided I'm just going to dump it into the Liesberg River. So by doing that, I'm now making a lot of profit for my shareholders. I'm increasing their wealth, and everything is hunky-dory. No, it's not, because it's not ethical. I am damaging the environment by polluting the river. So everything we do, we must always make sure that we do it in an ethical way. And yes, unfortunately, ethics means different things to different people. But I think generally we all know when something is wrong and when something is right. For example, if you want to make money, you can sell any normal good. You can sell fruit and vegetables, and you're going to make some money. Or you can sell drugs, and then you can make lots of money. But that's not ethical and it's not right. Okay, so whatever we do, we have to look at the considerations of ethical or unethical and wrong and right. Okay, then lastly, we come to what is called the agency problem. So what the agency problem is the following. If we look at a business, the shareholders, which is called the principal on the left of the picture, okay, they hire managers to manage the business for them. Okay, and those are called agents. And the agents must perform to the benefit of the principal or the owners of the business. So each of these two, the principal, have got their self-interest. They want to make money. That's what they want. That's their goal. That's why they invested in the business. And then you get the agent, who also have a self-interest. They also want to make money and also have benefits. Okay, so the agency problem is where the managers behave in a way that is to their benefit and not to the benefit of the shareholder. That, in a nutshell, is what the agency problem is. Okay, so if you look at examples, I know Eskom is very much in the news lately, and we hear of people being arrested, where they would sign an agreement with a supplier. The supplier will give them a kickback, and at the end of the day, Eskom suffers, and we have load shedding. And in the case of Eskom, the principal is the government, they're the shareholder, but we are, again, the shareholders of government, if you want to look at it that way. So again, the agents are not acting in the benefit of the principal. So This happens in private business, it happens in government, it happens all over. Typical example is there's a soccer tournament on somewhere in the UK, World Cup, and then the manager, senior management of the company decides they're going to fly to London to go watch a soccer game and the company pays everything, and they take their spouses with, and they'll write it off as a company expense. Now, again, that's money that belongs to the shareholders, the profit, but they have now used this for themselves. So that is part of the agency problem. Okay. Okay, so next lesson we'll be looking at is what is accounting and what's financial management in more detail. Okay, this was a fairly quick session. Thank you very much. If you have any questions, you can email me. My email is on Cole Campus. So any questions, please let me know. Thank you and goodbye.